Thank you for having me. So when I think about our philosophy, right, and this is really about the philosophy that gets you to be excellent, excellence is so core to us, and as I go through the different words that define our philosophy, I think it's trying to really focus on what do you mean by a buzzword like excellence. And for us, we measure excellence by what we mean by it is continuous improvement. Everybody starts somewhere, and the question is, can you as an individual and you as an organization continuously improve? That's what we would define as excellent. And so if I start with what, let's see if I got this here. What are we trying to be excellent at? And Bridgewater's been doing two things for its whole existence, 50 years. I've been at Bridgewater for 29 years. And we focus on two things, which is to deeply understand how the economic system works and apply that to build great portfolios. So we're trying as an organization to be excellent at that, which means to continuously improve that. And there's three components that are critical to really understand our philosophy. One is what we mean by fundamental. So fundamental means what actually drives markets, that we believe that you can understand this, that there are decisions that people make, they make them for reasons, those reasons add up to what we consider the fundamentals. That those ideas can be, you can think of them qualitatively. They're not like, not everything that you're thinking matters is measurable in a traditional qualitative sense. But in any event, that's what we mean by fundamental, which is what are the true causes for the things that you see in the world. And then the second step that we take is to take whatever you believe and systemize it. What we mean by that is have the rigor to take the reason that's in your brain, right? It can be a qualitative idea, but there is a reason the synapses in your brain are doing what they're doing. And somehow there are inputs coming in, there's logic being applied to those inputs, and outputs coming out. You can take the energy to systemize that understanding, and it's critical. I'll talk about why that, for us anyway, that's so important. And the last thing is have a strategy for being wrong. Our strategy for being wrong is diversifying, but there's different strategies, but you need to know that whatever you believe, with whatever confidence, you're gonna be wrong a tremendous amount. So those are the three kind of core things I'll dig a little bit deeper on. So first off, what could we mean by fundamental? What are truths that when we try to discover what's true about markets and economies, there are things that are going to be true now, that are true wherever you place yourself in the world, that are true at any moment in history, and we expect to be true at any moment in the future. I mean, the first one of those things we'd start with is that there's two core ways to make money in markets. One is to take on risk. That's a risk transfer to you, that somebody's offering to pay you because you're in a position to take risk they don't want to take, right? That's what that general category, we call that beta. Not to be too, like there's semantic arguments about what beta means, but for us, we just mean the amount of money you get paid for taking on somebody else's risk. Then there's a separate point, which is alpha, which is the money you can make by making smart decisions in terms of timing, in terms of valuation, et cetera, that go beyond just taking on the risk. So we think about trying to separate that and think of every investment as the risk-neutral position plus the beta, so what the asset classes are that you hold and the risk that you're transferring, plus the alpha. That's very different. The way we look at it, that sort of formula of how you get a total portfolio return, is different than how most organizations structure their investments. Most organizations think of their total return as their holdings in each asset class, holdings in stocks, holdings in bonds, holdings in private equity, et cetera, and those sum up. Right? And the difference is you don't have to combine your alpha with your beta. You can separate those two decisions, and that's a big deal. So first off, understanding those two return streams, recognizing they're different, and the way you can combine them together can actually significantly improve how you invest. So now when we come back to fundamentals and we think about what are fundamentals that are timeless and universal, what can you say about markets that's gonna be true 100 years from now, is true in China, is true in the United States, is true here in Norway? Because you really want to base your beliefs on things that are fundamentally true and then build out the deep understanding about those things. So to give you two examples of what we mean by things that are timeless and universal, that the first is that the price of anything is equal to the amount of currency spent on it divided by its quantity, right? That seems simple, but it's actually a world of understanding to say, well, how much money is going to be spent on something? How much supply of it exists, right? And you can fundamentally build that, and you can build that in any time, in any country. And I'll get into how we check that those things are true anywhere. Similarly, the price of something is equal to the discounted economic conditions that affect it. And so when you look at the changes in prices, it's because something happens relative to the discounted economic conditions in that asset. Those two things are true all the time and everywhere, and those are big building blocks to then build a process around. So when we've been building processes to measure that, to measure those cause-effect linkages of things that we believe to be true, really starting in 1980. So the first thing I'd say now, we'll talk about making decisions systematically. Why do you do this? It's such a pain, right? Why do I have to write down what I believe? Why do I have to stress test whether it's true? I mean, most people want to skip that step because it's like, okay, it seems like this is going to happen or that's going to happen. And it's been such a huge building block in our organization to say, no, we're going to have the discipline to always write down our reasoning, right? So when we talk about making decisions systematically, this is not a quantitative thing. This is about having the discipline to say, this is why I'm doing what I'm doing. That opens up a world. So if you look at the yellow piece of paper that's up there, that was our 1980 bond system. So in 1980, you can picture Bridgewater, it was yellow piece of paper, rules that were written out. We're going to buy bonds if this happens, we're going to sell bonds if that happens. That were rules about what thought about money supply and other things at the time. The idea itself is not that useful, but the process that it kicked off was critical, which is we just scratched out one of those ideas, put in another one, learned another one. But you start with this building block of what do you believe so that others in the organization can question that. It's forcing you to actually state what your logic is. And that allows constant compound improvement. That's really such a critical element to our philosophy. And the benefit of that is you can check yourself. So what I'm showing here is just an example. If you said, okay, let me say what I think, right? Right now you might think, well, the capacity utilization in the United States, like the economy's running hot, and that running hot could lead to higher wages and maybe higher inflation, and therefore I want to take this position in markets. Right? And the great thing about forcing yourself to, okay, that seems reasonable. Like, let's write it down. Let's see if that's true. When is it true? If you use that rule, will it actually work in history, right? Force yourself through that. Put yourself at different points in time. That'll force you to refine your thinking, right? If you just take that idea, that's like just something I've recently heard a fair amount, so I just wrote it down so it could show. And then you could, have technology to just test, okay, well, let's say you follow that rule. Does it work or not? And what you find most of the time is actually a lot of time it doesn't work. So now you think, well, I must not know. What I'm saying isn't that reliable, right? And I show like a profit curve of the alpha of that rule, and it's actually okay for a long period of time and then flat for the last 35 years. Why would that be? Why is that getting priced into markets? What's going on, right? And the benefit of writing down your rules is you could actually see whether they work. And that's a huge, huge deal. Beyond that, you can also know what you're in for. For every idea that we ever use to invest, we start with what do we expect from it, right? And so this cone chart illustrates this. But every idea that we use in investing, we say, okay, what are the risk and the return that we expect from this idea in the future? And that gives us an opportunity to then compare what happens relative to that, right? So the cone chart is when we first started the idea. So in 1991, as an example, we started the idea of pure alpha, which is all of the alpha ideas we had at the time put together, and then we've added to them and subtracted from them. But and we set out a cone chart and said, this is what we expect the risk return to look like into the future. And every day we mark what's happening relative to that expectation, right? And we do that with every single idea, which is automatic quality control. You could say, okay, if my idea doesn't work out consistent with how I expected it to, then, okay, the world's different than what I thought. And on the other hand, if there are drawdowns in that idea, which there always will be, you plan for it in advance. You're not reacting to that drawdown. You're saying, okay, if I have a drawdown of this nature, I'm not perplexed by it because I knew it would happen. I expected that to happen. So knowing what's inside the bounds of what you expect and what's not is another critical element. Now, the next point is probably the one that's most sort of under fire at this point in history because diversification hasn't been doing that great as a concept. But if we thought about the holy grail of investing, right? What do we actually want if you want to achieve your goals in investing? It's to have something like 15 to 20 uncorrelated return streams. This is kind of what we're seeking. You'll never actually get there because things are too correlated to quite get to that level. But if you're seeking ways that you can make money in markets that are unrelated, right? And the benefit of that is you can translate, if you basically look at this chart, most things, if you take most of the investments that you're all invested in, are reasonably highly correlated. They're on the top left. That means you can buy a whole bunch of them. You're not actually getting much diversification if you see this curve. If you're able to select strategies that are uncorrelated and you can move down that curve, you can improve your reliability 3, 5x with equally good ideas if you're getting uncorrelated ones. So that is really that seeking, that search for what are paths to get positively expected returns that are uncorrelated to each other. So that's, again, a hugely important part of our philosophy. And to do that, what you need is to put them together in a way that actually works. So when you do balancing and diversifying in terms of risk instead of in terms of capital is so critical. So it's usually people think in terms of, okay, I'm going to invest X in this asset, Y in this asset, et cetera, in capital terms. Restructuring your thinking to think in terms of, I'm going to allocate risk to different things, and then I'm going to try to balance that risk among things that are diversifying. So that means you have to take high-risk strategies and to lower the risk on them, and take low-risk strategies and raise the risk on them in order to get diversification across them, right? And that's another attribute of when we're thinking about diversifying. Now, to slow down a second, just to put that into practice, right? So when you think about the concepts that are behind pure alpha, that is sort of the best we could do in generating alpha in the world. The concepts start with the deep understanding of the world. Having studied everything that exists in the world that we can think of for 50 years, taking that yellow piece of paper, crossing out things we don't like, adding things we learn, building those into algorithms that reflect everything that we've ever thought of, right? This kind of gives you a sense of how that literally works. So it starts with different ideas on the left here. That you'll have different approaches to trading the market. This is, again, part of diversifying, right? You might think in terms of fundamental principle of value, that eventually that the cash flow of an asset is going to equal the present value of all the future returns that you'll get. You could build that deep understanding of what causes that, what an asset should be worth today, right? That can be one perspective on that market. That isn't going to help you that much in the next 6 to 18 months. It helps to some degree. It won't help you that much. So you need other perspectives. Well, what are the other drivers beyond value, right? We think of essentially the movement in the fundamental conditions that matter. So how do you measure those? How do you build that into a decision rule? We also think about the effect that other markets have on that particular market. Again, how do you build that whole world out? Why do other markets affect this market? How does that actually work? And then the fourth thing is who all the buyers and sellers are. One of the reasons things go far from fair value is because buyers and sellers do things for reasons other than the long-term cash flow effect. And understanding the balance sheets of those players, where they get their money from, how that works, those pieces all combine together. And you could think of it as we have all of those ideas that we've been working on for years. You can think of it as four people arguing with each other with different perspectives on markets that you then put together to get to a view in a market, which is kind of then the thing that's on the next diagram here on the chart, which is, okay, you could translate those different people's views into a systematic process, build that systematic process to combine that information into one view of a market, right? So that we take that second step. Then we take those signals that we've combined together and build that into a risk pie. So say, okay, well, how much risk do we want to put on each one of those strategies? How much risk would we put in each one of the markets? Again, trying to move ourselves as much as possible to the holy grail of 15 or 20 uncorrelated return streams. And that's then, the pie chart shows the risk budget we try to get over time, which is a very balanced risk budget across many different markets, across very many different strategies across those markets. But at a point in time, which is then the furthest right chart, you're not going to have views on everything. That's another big, important philosophical thing, is you don't have to have a view on everything. You have this world of opportunities to take advantage of. You don't have to have a view on everything. So translating your views at a point in time, that things that you have strong views on, through a risk budget that's an across-time risk budget, you can sort of multiply the signal by the risk budget to get the overall portfolio that you end up with. So that's how we kind of put these pieces together in an approach that starts with qualitative thinking about, from experts on like, why would you buy a bond? Why would you buy a currency, et cetera, et cetera. Translating that qualitative thinking, interrogating it until you could translate it into an algorithm. Using those algorithms to look everywhere in the world so you can be massively diversified, because now if you've actually taken the logic of why would you buy a bond, why would you buy a currency, you could apply that anywhere in the world. If you've done it well and deeply, you can apply it everywhere. So you could apply those rules while you're not even realizing something's happening in a country or whatever. And you could build out a portfolio that way, measuring point in time conditions, reflecting all that logic that you've built up over 50 years of compounding. Right, and that's kind of the last point that I'd say. If you just talk about our philosophy, it starts with constant improvement. And if you actually do constant improvement as an organization and you compound that understanding, right? You think about compound returns in the context of an investment. If you think of it in terms of an organization, what you really want to do is compound understanding. Like, what does the organization actually know? And how do you keep building that out? Right, and so this diagram on the left, it's going to be a little hard to say, but basically this is my view of the three pieces that we've been doing to build out our understanding that allows us to compound as an organization. The first is what's reflected by that cube, which is that everything we've ever learned at Bridgewater that we thought has value, we have translated that into an algorithm. That algorithm itself is data that's been stored. Everything we've ever learned about currencies, bonds, economies, growth, inflation, everything's been learned. Everything is stored in a way that's organized such that you can find it, you can utilize it, others can build upon it. We make everything that we've done, we have the standard of it has to be computer readable, which means we run it 3 times a day. It's always updated, it's always got the newest information, and human readable, which means that a human expert can look at this and understand it. An investor can see this. It's not buried in code, but that it's available, everything that we've ever learned. That's what the cube represents. Now, to have an organization of hundreds of people working on that cube, you need what the pyramid represents, which is, well, how do you do it? When you learn something, where do you put it? How do you reflect your qualitative understanding in ways that then others can access? Right? So the pyramid, and what we have in there is essentially our rule book of how you go about from an idea to getting the data you need to fuel the idea, to building the visualizations that other people need to understand your idea. Right? And so that is the second component of it. And then the third component of it is the circle around it, which reflects the learning process, the constant learning process. You'll always be wrong about a ton. We have 2 inputs into our process. One is the basic circle, which is we're constantly making predictions about the world. We're constantly getting them wrong. We're constantly learning by digesting why that happened, looking back and building that out. Then there's also inputs in the world, something you've never thought of before, new things happening, right? And the great thing about having a systematic process is you could spend all your time on what you might be missing in that systematic process. How do you deal with geopolitical tensions and tariffs and changes in trade patterns, et cetera? You might not have that in your process, but if you have a process that reflects everything you think about, you can spend all your effort on the new problems. Right, and the chart on the right is kind of what I want to leave you with. It's the compounding point. that if you start, this is true of investments obviously, but true in an organization and understanding. If you start with a basic level of understanding in 1980 on a piece of paper, and you keep crossing things out and learning and learning and learning, and that thing is not in your head, so it doesn't leave when you leave, but it's actually reflected in that process that others can build on, your understanding follows a compound return curve as an organization the same way that an investment can if you continue to compound. So that's our philosophy.